There is a sequence that history repeats with uncomfortable precision. A leader falls, a critical supply route closes, and somewhere in the weeks that follow, the purchasing power of ordinary people begins a quiet, irreversible decline that no government press conference ever fully explains. The sequence is not new. It is old enough to predate the printing press, old enough to predate central banking, old enough to predate every institution that currently manages the relationship between money and the goods it claims to represent. And it is playing out again right now with a specificity that demands attention from anyone who understands that monetary history is not a collection of curiosities, but a manual for recognizing what comes next. On the morning of February 28, 2026, the supreme leader of Iran was killed in coordinated strikes by the United States and Israel. Within hours, Iran's Revolutionary Guard declared the Strait of Hormuz closed. Within days, tanker traffic through the world's most critical energy choke point had effectively ceased. Insurance underwriters withdrew. Qatar halted. Liquefied natural gas production after Iranian strikes hit its facilities at Ras Laffan. Brent crude surged past $83 per barrel. Analysts warned of scenarios approaching $200 if the closure held. European natural gas futures jumped more than 30% in a single session. This is the surface of what happened. The surface is not the story. The story lives in the structural reality that every major currency in the modern era was built on an assumption now being tested in the most direct possible way. The assumption is this: that energy flows would remain sufficiently stable to prevent the kind of supply shock that forces monetary systems into choices they cannot survive with their credibility intact. That assumption has been tested before, and every time it is broken, the currency of the nation carrying the heaviest monetary burden has paid the price not in days, but in years of silent erosion that ordinary savers never saw coming until it was too late to protect themselves. This is the mechanism that connects a supreme leader's death to the purchasing power of currencies held by people who will never visit the Persian Gulf. Before the dollar, before the euro, before every modern reserve currency that currently anchors the global financial system, there was a version of the same architecture, a dominant power, a critical trade route, a currency whose credibility rested on the assumption that the system underpinning it would remain intact. In 1956, that dominant power was Britain. The critical trade route was the Suez Canal, and the currency was the pound sterling. When Egypt nationalized the canal and Britain launched a military operation to retake it, the event that followed was not a military defeat. Britain won on the battlefield. It lost somewhere far more consequential. The United States, alarmed by the geopolitical implications, threatened to sell its holdings of sterling bonds. Britain, carrying a debt burden from the Second World War that had already strained its fiscal position, could not absorb that pressure. The pound collapsed, the IMF was called, the operation was abandoned. And within a decade, sterling's status as the world's reserve currency had passed irreversibly to the dollar. The mechanism was not military, it was monetary. Britain's currency credibility rested on the assumption that its geopolitical position was strong enough to backstop the promises embedded in its paper. When that assumption was exposed as fragile, the currency paid the price, not overnight. Gradually, then faster, then in a way that was impossible to reverse. This is not an isolated episode. It is a pattern with a name that monetary historians trace across centuries. A dominant power extends its monetary credibility on the basis of geopolitical strength. That strength allows it to run deficits, issue debt, and print money, beyond what its underlying productive economy would otherwise support. The arrangement works until a shock arrives that exposes the gap between the credibility claimed and the credibility actually possessed. At that point, the adjustment begins. And the adjustment is always inflationary. Not because governments choose inflation, because the alternatives, immediate debt restructuring, dramatic fiscal contraction, honest acknowledgement of insolvency, are politically impossible. So the system absorbs the shock through the one mechanism that distributes the cost most invisibly, the gradual dilution of purchasing power, which arrives in consumer prices months or years after the monetary decisions that caused it. In October 1973, the Arab oil embargo removed roughly 5% of global oil supply from the market. The price of oil quadrupled in less than 3 months. The United States, running a fiscal deficit already strained by the Vietnam War and the abandonment of the gold standard, 2 years earlier, had no monetary room to absorb the shock without consequence. Inflation rose from around 3% in 1972 to 14% by 1979. The result was a decade of stagflation that destroyed the purchasing power of anyone holding dollar-denominated savings through that period. The dollar did not collapse, but the promise embedded in the dollar was quietly, irrevocably broken for an entire generation. What is happening now in the Strait of Hormuz is structurally worse than 1973. In 1973, the disruption was a policy decision made by producing nations who retained the option to reverse it when circumstances changed. The 2026 closure is the consequence of active military conflict with no clear off-ramp, no neutral mediating party, and no mechanism for the quiet diplomatic resolution that ended the 1973 embargo within 6 months. In 1973, approximately 12% of global oil supply transited the relevant choke points. Today, the strait carries approximately 20% of daily global oil consumption and 22% of global LNG trade. The scale of potential disruption is larger. The fiscal position of the major reserve currency nations is weaker, and the institutional credibility that allowed central banks to manage the 1973 shock has been eroded by 15 years of extraordinary monetary policy that has already expanded money supply to levels leaving far less room to absorb a fresh inflationary shock. The United States entered this conflict carrying a national debt that requires the Treasury to refinance trillions of dollars in obligations annually at interest rates not seen since before the 2008 financial crisis. Debt service costs have become the single largest line item in the federal budget, exceeding defense spending. The fiscal margin to absorb an energy shock of this scale is structurally thinner than at any point since the immediate aftermath of the Second World War. History is very specific about what happens when a reserve currency nation with an elevated fiscal burden encounters an energy shock it cannot fully absorb. The Federal Reserve faces a choice with no good options. Raise rates to fight inflation, and the debt service burden becomes existential while the economy contracts under pressure that generates political demands to reverse course. Hold rates or cut them and inflation accelerates, purchasing power falls, and monetary credibility erodes in the way it always erodes, slowly, then suddenly. There is a dimension to this crisis that separates it from every previous energy shock since 1973. That dimension is the parallel monetary architecture that has been quietly assembling itself in the years leading up to this moment. Russia's gold reserves reached $326 billion in value at the start of 2026. A gold-backed BRICS settlement. Currency processed its first commodity trades. China accumulated physical gold at rates its official reporting does not fully reflect. The dollar's share of global foreign exchange reserves fell from 71% in 1999 to 53% in 2025. These are not unrelated trends. They are the components of a monetary transition already underway before the first missile struck Tehran. The war has not created that transition, but it has accelerated it in the specific way that geopolitical shocks always accelerate structural transitions already in motion. Every time a reserve currency faces a crisis of credibility, the nations holding that currency in their reserves ask themselves a question that was previously too costly to act on. The Roman denarius carried 90% silver in the 1st century AD. By the 3rd century, the silver content had been reduced to 2%. The process was gradual, motivated by military costs, debt service obligations, and the political impossibility of honest fiscal contraction. The Iranian rial traded at 70 to the dollar in 1979. At the time of Khamenei's death, it traded at over 1,400,000, a currency that lost 20,000 times its value in 47 years, not through a single catastrophic event, but through the cumulative weight of sanctions, military spending, and the systematic subordination of monetary credibility to political survival. The mechanism is the same mechanism now operating in less extreme forms in every currency, absorbing the consequences of a war it did not choose, in a strait it cannot control, at a moment when its fiscal architecture has less room to absorb the cost than at any previous point in living memory. There is also something worth examining in the specific character of this war's monetary transmission that distinguishes it from every previous conflict involving the Persian Gulf. In previous episodes, the 1973 embargo, the 1979 revolution, the 1980 to 1988 Iran-Iraq war, the 1990 Gulf War, the disruption was temporary and the monetary system had sufficient credibility reserves to absorb the shock and restore equilibrium without fundamental restructuring. The common element in each of those recoveries was the existence of institutional credibility that had not yet been compromised by the extraordinary monetary policies of the post-2008 era. That credibility reserve does not exist today in the same form. Central banks that spent 15 years telling markets they could manage any shock have spent the past 3 years demonstrating the limits of that management. The tools that worked in 2010 do not work in the same way in 2026 because the conditions that made them work, low inflation, fiscal space, institutional trust, have been substantially depleted. Consider what the closure of the strait means beyond the immediate energy price shock. Approximately 150 vessels are anchored on either side of a waterway that normally processes 20 million barrels of crude oil per day. Those vessels are not moving. The insurance underwriters who would cover their transit have withdrawn. The protection and indemnity clubs that backstop commercial shipping in the region have suspended war risk coverage. This is not a temporary inconvenience. It is a structural seizure in the most important logistics corridor in the global economy. Every refinery in Asia that depends on Gulf crude is drawing down inventories. Every petrochemical plant processing Gulf feedstocks is calculating how many weeks of production it can sustain before its input costs become unmanageable. Every government importing energy through this corridor is running the same fiscal calculation. How much of the cost increase can we absorb through subsidy before the political pressure of visible inflation becomes unmanageable? The historical record on that last question is instructive and uncomfortable. Governments that attempt to absorb energy price shocks through subsidy invariably delay the consumer price impact while accelerating the fiscal deterioration that makes the eventual adjustment larger. Japan, after the 1973 embargo, subsidized fuel costs and experienced a delayed but severe inflationary episode. European governments that cushioned the 2021 and 2022 energy price spikes through fiscal support emerged with debt levels that further constrained their options for the next crisis. The pattern is consistent. Subsidies redistribute the pain across time but do not eliminate it. The monetary system absorbs the fiscal cost of the subsidy through the same mechanism it always uses: issuance, expansion, and eventual dilution. The consumer who is protected from the immediate price spike pays through the slower, less visible erosion of purchasing power that follows when the fiscal bill comes due. The people who pay in these adjustments are always the same people. They are the ones who held savings in the currency that was doing the adjusting, who trusted the number on their account statement to represent something stable, who assumed that the institutional architecture managing the relationship between money and value was more robust than the events now unfolding suggest it actually is. The people who did not pay were the ones who understood before the adjustment became visible in consumer prices that the gap between what was claimed and what was real had grown large enough that no single shock could be managed away. We are at the chapter where that gap becomes visible, where the models, assuming normal conditions, are confronted with conditions that are structurally abnormal. Khamenei is gone. The oil is gone from the strait. The next chapter of monetary history is being written, not in headlines, but in the purchasing power of currencies built on assumptions the world no longer fully supports. The event isn't the warning.